The Bank of the United States was chartered in New York State in 1913, founded by Joseph Marcus, a businessman from the garment industry. The name was not chosen at random. State regulators at the time questioned it, concerned that customers would mistake it for an arm of the federal government. They approved it anyway, and the concern turned out to be justified. Immigrants arriving in New York, many of them from Eastern Europe, heard the name and trusted it the way they might have trusted the Treasury Department. Whether by design or by consequence, the name made the bank feel safe to people who had every reason to be cautious with their savings. After Joseph Marcus died, his son Bernard Marcus took over leadership and pushed the bank into rapid expansion through the 1920s. Branch after branch opened across the Bronx, Brooklyn, and Lower Manhattan, placing the bank directly in the neighborhoods where Jewish and other immigrant communities lived and worked. By 1930, the institution operated roughly 59 branches and held accounts for approximately 400,000 customers. By number of depositors, it was one of the largest banks in New York and, according to accounts from the period, among the largest in the country. Growth at fast required funding, and the source of that funding would become the bank's central problem. Much of the bank's expansion was financed through a network of affiliated real estate companies. These affiliates borrowed from the bank, acquired properties, and generated paper profits during the boom years of the 1920s. The arrangement was legal under New York banking law at the time, but it concentrated risk in a way that ordinary depositors could not see. The bank's financial health was bound up with New York real estate values and with the condition of companies that only insiders could truly assess. When property markets began to soften after 1929, the affiliates started generating losses, and those losses accumulated just out of view of the people with money on deposit. The stock market crash of October 1929 did not immediately destroy the Bank of the United States, but it began a slow erosion of the foundation. Securities values fell, real estate lending tightened across the city, and the affiliated companies found it harder to service the debts they owed back to the bank. Through most of 1930, the bank remained open and operational, and for most depositors, nothing appeared to be wrong. But by autumn of 1930, New York State banking regulators had grown concerned enough to examine the books closely. What they found in the affiliate structure alarmed them. The bank needed either a significant infusion of new capital or a rescue arranged through the private banking system. In early December 1930, New York State Banking Superintendent Joseph Broderick convened a series of emergency meetings. The New York Clearinghouse, the association of the city's major banks, was asked to arrange a rescue, pool resources, absorb the Bank of the United States into a stronger institution, and prevent a public panic. The large Wall Street banks declined to participate. The precise reasons remain contested among historians. Some contemporaries and later scholars, including Milton Friedman, pointed to the bank's heavily immigrant Jewish depositor base and management as a factor in the establishment's indifference toward arranging a rescue. Other historians emphasized the genuine uncertainty about the scale of the affiliate losses and the major banks' reluctance to assume liabilities they could not fully evaluate. What is clear is that no deal was reached and time ran out. On the morning of December 11, 1930, New York State closed all 59 branches of the Bank of the United States simultaneously. The closure was the largest commercial bank failure in United States history up to that point. Depositors arrived at branches across the city and found locked doors. Lines formed on the sidewalks. People who had trusted the institution for years, sometimes for a working lifetime, stood outside in December cold trying to understand what had happened to their savings. The bank had held deposits from approximately 400,000 customers, and all of them were now cut off from their money with no immediate guarantee of when or whether they would see it again. The failure of the Bank of the United States did not stay contained to New York. News of the collapse spread quickly, and depositors at other banks across the country began to question whether their own institutions were equally vulnerable. The weeks following December 11, 1930 saw hundreds of bank failures cascade across the United States. This was a materially different event from the stock market crash of October 1929. The 1929 crash had damaged portfolios and corporate balance sheets. The bank failures of late 1930 and 1931 destroyed the savings of ordinary households, froze credit to businesses and individuals, and pulled money out of circulation in a way that deepened an already severe economic downturn into something far worse. The Federal Reserve System had been created in 1913 in part to provide emergency liquidity during banking panics, to be the backstop that prevented solvent banks from being dragged down by depositor fear. In the view of economists Milton Friedman and Anna Schwartz, whose 1963 work, A Monetary History of the United States, became one of the most cited studies of this period, the Federal Reserve's failure to act as a lender of last resort during the banking crises of 1930 through 1932 allowed the money supply to contract by roughly one-third, turning a serious recession into the Great Depression. This argument is widely accepted among economists, though some researchers have debated the precise counterfactual of what a more aggressive Fed response would have produced. What is not seriously contested is that the money supply did contract severely, and that the Fed did not deploy the tools its mandate gave it. Between 1932 and 1934, the U.S. Senate Banking Committee, guided by its counsel Ferdinand Pecora, held hearings that became a public reckoning for American finance. The hearings exposed conflicts of interest, insider lending, and the affiliate structures that had undermined institutions like the Bank of the United States. In March 1933, just 2 days after taking office, President Franklin Roosevelt declared a national bank holiday, temporarily closing every bank in the United States while Congress drafted emergency legislation. The public, which had watched hundreds of banks fail over 3 years and had seen the savings of ordinary people vanish, was by that point prepared to accept structural reform of a kind that would have been politically unthinkable before 1929. The Banking Act of 1933, signed on June 16, 1933, created the Federal Deposit Insurance Corporation. The FDIC opened for business on January 1, 1934, initially insuring deposits up to $2,500 per account. The logic was straightforward and powerful. If depositors knew that their money was backed by the federal government up to a stated limit, they would have no reason to run. A bank run is driven by fear. Remove the fear and you remove the run. Congress had spent 3 years watching a self-reinforcing dynamic destroy the banking system, where the act of worried depositors withdrawing their savings caused the very failures they feared, and had decided that the most dangerous thing a depositor could do was act rationally on imperfect information. Deposit insurance made that particular form of rational panic economically unnecessary. The FDIC's record since January 1, 1934 has been one of the more consistent policy outcomes in American financial history. Despite hundreds of bank failures in the decades that followed, including the savings and loan crisis of the 1980s and the failures of 2008, not a single depositor holding a balance within the insured limit has lost money because of bank failure. The insurance limit has been raised many times over the decades. In 2008, during the financial crisis, Congress temporarily raised the coverage ceiling, and the Dodd-Frank Act of 2010 permanently set the limit at $250,000 per depositor per institution per ownership category. The core mechanism has not changed. The government absorbs the loss so that depositors do not have to, and in absorbing it, prevents the panic that would have made the loss far larger. If your bank is FDIC insured, your deposits are protected up to $250,000 per depositor per institution per ownership category. That protection exists because in 1930, people who had done nothing wrong stood outside a locked bank and discovered their savings were inaccessible. Policymakers decided that outcome was preventable, and they built a mechanism to prevent it. Understanding why deposit insurance exists is not merely a history lesson. It clarifies what protection you actually have, how it was designed, and what conditions it was built to address. It also reveals why the guarantee has a limit. Every policy that eliminates one kind of risk creates the possibility of another, and the debate over where exactly to draw the line between protection and the incentives that protection changes is a debate that has not ended.